All right, welcome future CMAs. Listen, if you are deep in the trenches of part one, you know external financial reporting is a huge deal. Well, today, we're going to zero in on one of the most critical pieces of that whole puzzle, asset valuation. It sounds kind of dry, but trust me, this is where we make sure the numbers are actually telling the real story of a company.
Okay, let me ask you something to get our heads in the game. You buy a house for 200 grand. Fast forward a few years and boom, it's worth $500,000. So what value do you think goes on the balance sheet? 200,000? 500,000? The answer, well, it's not as simple as you might think, especially when we're talking US GAAP. And that's exactly what we're going to get into today.
So, what's the big deal with valuation? Really, it's all about telling the truth. It's about putting the right dollar amount on what a company owns. And you have to get this right. I mean, think about it. If your assets are wrong, your equity's wrong. And if your equity's wrong, you're basically misleading your investors about how healthy the company is. It's that serious.
All right, so how do we actually do this? Well, US GAAP gives us what I like to call a measurement toolbox. There are 5 different methods we can use.
Okay, here they are, the 5 big ones. You've got historical cost, which is basically the price on the receipt when you bought it. Super simple. Then you have things like present value, which is all about future cash. But here's the deal, and this is a huge tip for the exam. Memorizing these definitions is step 1. The real key, the thing that separates a pass from a fail, is knowing which tool to pull out of the toolbox for which job. It's all about context.
So let's put these tools into action. Now, if we're talking about the CMA exam, there are 2 asset types they just love to ask about: inventory and fixed assets. Your property, plant, and equipment, or PP&E.
And this is where you can see they live totally different lives, right? Inventory is meant to be sold. It starts at what you paid for it, but if its value drops in the market, you have to write it down. You have to reflect that reality. Now, fixed assets, they're meant to be used. Their value goes down in a predictable way through depreciation. And yeah, if something bad happens and its value crashes, we call that an impairment. You write it down. But here's the kicker. It never, ever goes back up. It's a one-way street. And for those fixed assets, this formula right here, you have to know it. Cold. It's not complicated, really. Your book value is just what you originally paid for it, minus all the value it's lost over time through use, that's your accumulated depreciation, and minus any big sudden drops, those impairments we just talked about. This is literally how we show an asset being used up on the books. Okay, CMA pro tip right here. You need to burn this into your brain for exam day. Under US GAAP, fixed assets are never written back up. I'm going to say it again, never. If the value goes up after you've written it down, US GAAP says, I don't care. It's a super conservative approach. Now, under IFRS, it's different, but for your exam, you gotta know this US GAAP rule. Once it's down, it stays down. Okay, but what about when we are allowed to use fair value? Say for certain investments. How do we know the number is any good? How do we judge the quality of that data? Well, that leads us right to the fair value hierarchy. I want you to think of this as a pyramid of reliability. Right at the top, you've got level 1. This is the gold standard. It's a quoted price on an active market for the exact same thing. Think about looking up Apple's stock price. Can't get more objective than that. Level 2 is one step down. It's still based on stuff you can see, but maybe for a similar asset, not an identical one. And then you've got level 3. This is the company's own best guess. It's based on their own models and assumptions, and let me tell you, auditors look at this level very closely.
Whew. Okay, we've gone through a bunch of rules, I know. So, what's the one thing, what's the master key that's going to unlock all of this for you when you're sitting in that exam?
This is it. This is the whole ballgame right here. Before you even think about a formula or a rule, you have to ask yourself, what is the intent for this asset? Are we going to sell it? Are we going to use it? Are we holding it as an investment? The answer to that question tells you exactly which valuation method to use. It cuts through all the noise, every single time. So as you keep studying, I want to leave you with this question to chew on. When a company uses that level 3 best guess valuation, how does that change the story it's telling everybody? See, what you're learning here isn't just about passing a test. It's about learning the language of business and how to tell an honest story with numbers. Remember that. Keep up the great work. You're gonna crush this. You've got it.